In this chapter, I want to take you through probably one of the most classical trading systems used by a hedge fund manager. But I'm going to take you through a simple version of it, just to give you, first of all, to give you the system, but also give you some understanding of how systems are constructed. Like with all the chapters I've done on anything to do with systems, I'm going to give you, first of all, the rules, and then we'll look at a couple of examples. As with anything, success isn't guaranteed. It's not the case that we make money no matter what, so do bear that in mind. This system is the turtle system. You might have come across it, but let's have a look at it. Now, the variation, the simpler version, we're calling turtle soup. It's not a name I've given, it's a name other traders have given. It's formed by a hedge fund trader by the name of Richard Dennis, bit of a celebrity, very successful for numerous years, a legend in the markets. The strategy does have certain negatives in that you're looking to trade breakouts. So let's say the price has done this, you're looking to trade it when it breaks out, and you can get false breakouts. Well, of course you can, it's not 100% sure. And also you can get quite large drawdowns in your capital. What that means is you could have a series of failing trades and you lose a bit of money, you lose a bit more, you lose a bit more, you lose a bit more. But that aside, and that's going to happen with any system. No system is going to have every single aspect which is going to be wonderful. But that aside, it's worth examining, and it is one which, although the signals come up relatively infrequently, they can be fit into our overall mathematics for trading systems, which I mentioned before. Right 7 times out of 10, get the 20% hits when we're right, the 25% losses if we're wrong, and just try and hit those returns time and time again. Now, these are the rules as stated for this. I'm then going to show you Turtle Soup plus 1, which is slight variation upon it and can be a bit easier for traders as well. Now, we're looking at swing trading. It's relatively short-term traders, though trade could be held open for weeks. Sometimes it might only be days. So let's have a look at it. Now, it talks about futures contracts because it was intended for the futures market, so it would apply to CFDs and to spread bets and to equities, but this is not the markets these guys were generally trading. That's why it says futures contracts must make a new 20-day low. And by the way, as I said, I'll show you the rules first, and then we'll go through an actual example. The previous 20-day low must have occurred at least 4 trading sessions earlier. At least 4 trading sessions earlier. So if you had something like this, where this is the 20-day low, then this can't be also the previous 20-day low. Basically, you're going to get a pattern where it falls and then it falls fairly sharply, and maybe you've had prices doing this, where this is the 20-day low, but this one obviously isn't because you had a price with 3 days there. So it's basically what this entry point is trying to say is, want to look for the kinds of trades where you get a sharp move down, pretty sharp move downwards first. And you'll see why that is, because it's actually looking to see, once you've got a sharp move down, is this the type of trade which is going to give us a sharp pullback? And the pullback is what we're looking to get into and trade off and make money from. So this highlights and qualifies us for a pretty sharp pull down. But how do we know we get a buy signal? Well, after the market falls below the previous 20-day low, so remember, it's had a previous 20-day low which occurred at least 4 trading sessions earlier. You place an entry to buy or go long 5 to 10 ticks above the previous 20-day low. So whatever that previous 20-day low was, and let's say it was whatever level it was, your buy stop is based on that previous day low. Once today's price has gone beneath it, that becomes your buy point. So it'd be a bit like that. So let's say that's the previous 20-day low, whenever that is. This has happened today, which is the new 20-day low. Your buy stop is based on the previous 20-day low as an entry point. Why? Well, because if the price has plunged this far and then starts rising, then that should give us some indication that the pullback is a breakout. In other words, when the price pulls back upwards, it gives us some room for deciding, yes, it's not just a false move upwards and then it'll continue, it'll go up and then back down again, but actually, if it's gone that far, the probabilities are it's going to go further. Why not put it further higher? Well, if you put it too far, you'll have missed the move. Remember what we said in one of the earlier chapters? We're looking to get in at this point. Not at this point, which we call point Y. We're looking to get in here when it's gone up a little bit. Not so it's gone up too much, and we want to avoid getting in while it's still falling. What this pullback does is ensure we're getting in whilst it's not still falling, but so that it's not too far ahead either. We're getting in at this point. Yeah? And this is one way in which we're trying to capture that mathematically. The buy stop will be good for today only. The trade is triggered. You place an initial good until cancelled sell stop one tick below today's low. So if the price did go below today's low, that's that point, then you get out. That's if you've already bought. So let's say this was the previous 20-day low, and so that's your buy point. This is your stop loss here, which is today's low. If the price did indeed break above that one, so you bought in, and then move back down again, then you know it was a false breakout. Yeah, that's why you have a tight stop loss. It meets that criteria. Remember, we want tight stop losses? Meets that criteria. That's why it's such a good system. And a very simple one. I have given you the simple version though. Let me give you Turtle Soup plus 1 before I show you an actual diagram. The reason I want to give you Turtle Soup plus 1 is because it can be a little bit easier for traders. The market must make a new 20-day low, same as before. The prior 20-day low must have been at least 3 trading sessions earlier. So you see a slight change there. You see how it can be tweaked. The close of the new low, day 1, must be at or below the previous 20-day low. So you're looking for a close of this new low below the previous 20-day low. Fine. An entry buy stop is placed the next day, day 2, at the earlier 20-day low. If you're not filled on day 2, the trade is cancelled. And sometimes I do amend that. Sometimes I might wait until day 3. So even if it's not filled on day 2, I might wait. That might affect the probability of being right, but still sometimes it's worth tweaking it based on experience and judgment. If the trade is triggered, place a protective stop 1 tick below the low of either day 1 low or the day 2 low. Yeah. The reversal is often short-lived, so take profits within 2 to 6 days. Trail stops on a position that move in your favor. So let's not worry too much about the exits for now, where we take profits. That's that rule. That's a separate issue. This is about entry. What are we doing? Let's say we had something like this, company called Cattles. This is a 20-day low. The previous 20-day low is at least 3 trading sessions beforehand. Do you see that? Do you notice how that 20-day low, that's the previous 20-day low. This is today's 20-day low. Yeah? So there we've got our entry point, just slightly above the previous 20-day low. Yeah, you've got your stop loss, which is down here. Notice how, in this case, I've waited. I've waited quite a few days before getting in, as opposed to following Turtle Soup plus 1, which is getting in the very next day. You can see where the stop loss is. Yeah, which is that low there. We nearly did hit it, but we didn't quite. Then you've got the entry when it breaks through this level here, which was the previous 20-day low, and you can see the size of the rally. Why should this work? Well, because it's like one of these trades. We didn't wait until we got to point Y, which is when we'll be somewhere like this, so it'd be too late. We didn't get in while it was still falling. How do we know it wasn't still falling? Because we waited until we got the price to move up a bit. This is your point X. Anything sooner, and it's too soon, it might still be falling, we don't know. Anything earlier, and it's still falling. Anything later, and it's too late. This point here gives us some balance between the probability of it continuing higher versus the probability that it's gone up a bit and gone down. Remember, we want to also avoid this happening too often. And that's the big danger. You get a bit of a price move and then it continues lower. In fact, all it's ever been is on a downward course. And what this trade does, what this kind of ruling does, is, if you look at it like that, is ensure that it avoids this situation as much as possible. Now, it's still going to happen. That's why this isn't going to work 100% of the time, and it's why we have a stop loss. And the stop loss is placed, down here. So you can tell that it is actually one of those, and it can be quite a tight stop loss. We entered here, you can see the stop loss there, and that's that. Yep, so you see the mechanics, you see the reasoning, you understand why this is the way it is. I'll give you a Turtle Soup plus 1 Antofagasta. And let's say we're looking at this. So we got 20-day low, the previous 20-day low over here, which we're going to put as an entry level, as a buy signal. We move forward, yeah, and we see, if we put the stop loss here, we see that in actual fact it breaks above the buy signal and moves on up. So we had a movement and a rally and a breakthrough. And as I said, sometimes I will amend the rules, tweak them a little bit. I might not get in the next day, I might have to take an extra day or whatever. Barclays. Again, you have got here entry at the previous 20-day low, stop loss at the low point, at the lower of the two lows, and got the entry there as it broke through this, and there you go, there's the rally. Pretty straightforward. Again, what it's trying to do is do this situation. Now, don't get me wrong, you'll have some of these where you'll get in and virtually the next day it'll start moving lower. But we want to certainly put the odds in our favour by avoiding getting in too early there and getting in too late. So all we've done is, as well as eliminate these types of trades, that should improve our odds and improvements, we're only doing these. Now, albeit that these will still only be right 7 times out of 10, but it's trade involvement has improved because we've got rid of these two other types. Yeah? So that's Turtle Soup and Turtle Soup +1 for swing traders.